Have you ever wondering how the market always seems to bounce back to certain zones? Almost like a magnet? You see a strong bullish move, then days later, price retraces back to a specific candle or zone before launching again. That is, my friend, is not a coincidence. It's smart money at work. In today's video, we are going to deep into the concept of fair value gaps, also known as FVGs. This is one of the most powerful tools institutional traders use, and now, you will learn to see what they are seeing. If you want to stop trading like the retail crowd, and start thinking like smart money, this video will open your eyes. We're going to break down everything from the basics of price imbalance, to identifying FVGs, and finally to building profitable trading strategies around them using smart money concepts. Whether you're trading Forex, crypto, or indices, by the end of this video, you will understand 1. What causes fair value gaps? 2. Why smart money bounce the trade back? 3. How to spot them with precision. 4. And most importantly, how to trade them for maximum profit. So let's get started. Don't forget to like and subscribe. First, to understand fair value gaps, we first need to understand the idea of price imbalance. Markets are designed to be efficient, that means, for every buyer, there must be a seller. But in reality, price doesn't always move with perfect balance. Sometimes, the market moves so quickly that it skips price levels, leaving behind zones where orders were never properly filled. This is especially true during news events, institutional order execution, liquidity grabs, major breakouts. When this happens, it creates what we call a price imbalance, a sign that smart money moved aggressively, and the market may later come back to that zone to rebalance. This imbalance leaves a gap on the chart between candles. Not a literal gap like in stocks, but a gap in price efficiency. This inefficiency becomes your opportunity. That's the basic foundation of a fair value gap. What is a fair value gap? So what exactly is a fair value gap? A fair value gap, FVG, is a three-candle pattern where the middle candle creates an imbalance in price. Here's how it looks. Candle 1, a bearish or bullish candle. Candle 2, a large impulsive candle in the opposite direction. Candle 3, another candle in the same direction as candle 2. Now, compare the high of candle 1 and the low of candle 3, for a bullish move. If there is a price gap, meaning candle 2 jumped through without touching those levels, you have an FVG. This gap is the zone where institutional orders were likely placed without resistance from the other side of the market. Think of it like this. The market rushed through a door so fast that it left it open. Eventually, it must come back and close it. The zone between the high of candle 1 and the low of candle 3 becomes your fair value gap zone, and price tends to revisit it. How to identify valid fair value gap? Number 1, this is an example of a valid bullish setup using smart money concepts, SMC. At the bottom, you see a bullish order block, the last bearish candle before the move up. Price react at the OB, showing institutional buying interest. The price breaks above a previous high, confirming a bullish BOS. This BOS is valid because it breaks a significant structure cleanly. After the BOS, a clear FVG is left behind. Price returns into the FVG zone, showing that the market is rebalancing the inefficiency. This FVG is considered valid because it forms after a valid BOS. It doesn't get filled immediately. Price comes back into the gap for a potential entry. Why this setup is valid? Proper BOS confirming a market shift. FVG appears after the BOS, not before. Order block is respected and price bounces from it. Number 2. Invalid setup. This is an example of a failed or low probability setup. An OB forms at the bottom, but it fails to hold price support. Price moves above it but then drops back, showing weak demand. This BOS is labeled invalid because it could be a liquidity sweep, fake out, rather than a strong structure break. Price quickly returns below the broken level. The FVG is invalid because it forms in a choppy, unclear trend. The BOS it follows is unreliable. price moves through the gap without respecting it. How to trade fair value gaps. We start by identifying the first break of structure, BOS, here. This signals a shift in market sentiment as price breaks above a previous lower high, confirming bullish intent. Then we get a second BOS shortly after, reinforcing the bullish market structure. You all notice 3 liquidity zones marked with dollar signs. These areas represent buy-side liquidity, where retail traders have their stop losses or breakout buy orders and sell order are there. Smart money often targets these areas to fuel price moves. The first dollar marks sell-side liquidity that gets swept before the bullish move. The second dollar lies above a short consolidation, it's taken out next. The third dollar is just above a recent high, another typical liquidity grab. Right here, we have a clear fair value gap, the imbalance between a strong bullish candle and the price action before and after it. Price later returns to this gap to rebalance orders. This is often a great entry point for institutional traders. Below the FVG, we have a powerful bullish order block. This is the last bearish candle before the explosive move up. Price comes back into this zone, taps it precisely, and then resumes the bullish trend. Order blocks are high probability zones used by banks and smart money to place their trades. Notice how price retraces right into the FVG and OB, then pushes up strongly. This confluence adds even more confirmation to a bullish setup. It's a textbook smart money play, liquidity grab, BOS, return to FVG/OB, and continuation. This chart is a great example of smart money concepts in action, showing how institutional players move the market with precision. If you understand these tools, you can align your trades with the big players and avoid getting trapped with the crowd. If you found this breakdown helpful, don't forget to like, subscribe for more smart money strategy content, and let me know in the comments if you'd like me to break down any specific charts next. Thank you. See you in the next episode.